Eric, we're back. It's wonderful to see you. I hope you had a great Thanksgiving. So, listeners, here's the outline today. We are going to be talking about what's going on in the market, Eric's big trip to Abilene, Texas, which we talked about in our last episode, and the new Goliath versus Goliath match that's shaking up the AI landscape that nobody saw coming, and yet everybody saw coming. And then we're going to talk about some of the earnings in the portfolio. So, Eric, at the top, how are you doing? How was the holiday?
I'm good. What's your Thanksgiving hot take? Do you hate stuffing? Do you love something particular? Like, what's your hot take?
My Thanksgiving hot take is that the politics family awkwardness that everybody memes about actually doesn't happen. It's a thing that people
Mm.
joke about happening at Thanksgiving, and very few people actually experience it. Maybe I'm wrong. Maybe I'm wrong. But I hear everybody joking about arguing about politics at Thanksgiving. I don't know if I've ever seen it up close or heard people complain about it after the fact. Maybe I'm just blessed. What about you?
So not a lot of potato slinging around the dinner table
No,
for
no, no.
you.
There were no mashed potatoes flying, and I think it is an overdone meme. What about you?
My hot take would be I want at least three stuffings at the table.
Ooh,
I need a variety. I would love a fast casual restaurant
that's
that
just
was just
stuffing.
like 15 stuffings. And then, you can add your stuff around it. But I would be all about that. But Austin, it is good to be back. Anyone watching on YouTube can see I'm back home, done traveling. I saw some really cool stuff out on the road we're going to talk about today. So I think it's going to be a fun episode.
Me too, me too. And look, there is a lot to be thankful for here. Your average recommendation has popped a lot. So this was a really strong rebound week. I mean, Thanksgiving, we were all out with family. I hope you weren't paying too close attention to the portfolio, but I know you were peeking a little bit. And we look back, and a lot of your picks rebounded. And if people listen to our last episode, you had given some really good guidance around optics and interconnects. And we talked about moving from copper to light. Looks like that bet paid off. But tell me about the portfolio. Your average rec back to 70%. What else are you seeing out there?
Yeah, I think one important thing, one of the key measures I think anyone who's investing should kind of put in their, you know, bucket of, things they use for gauging market sentiment. Google Trends. It's really easy. You just type in Google Trends. You can type in anything. If I'm looking for how retail investors and people are feeling about the market, I'll look at stocks to buy. You're only asking for stocks to buy if you're excited. Look at where that is on a sentiment scale. You can also look at trends like AI stocks. We can put on the screen for anyone watching on YouTube right now. But Austin, it is kind of remarkable, as you noted. We are back to our high performance watermark right now. The average recommendation is up around 70%. Interest in AI stocks was at about a 100 indexed in early August, and now it's at a 20 right now. And Austin, you see it as well. We can look. If you look at the downloads for the show, people are just very uninterested at this moment. But I will say to investors, being able to invest when the herd, when the broad group is most uninterested, is a superpower. Being able to invest at the moments you've gone from checking your brokerage account 4 times a day to once a week is a superpower. So, while the market itself is back close to all-time highs thanks to that rally around Thanksgiving week, there is still a lot of negativity in the market. Media mentions of AI being a bubble relative to anything good about AI is probably running at a 10 to 1 rate. But as you noticed, we've seen tremendous performance, especially from our optics category. I've got some of the returns. Lumentum up 295% since we recommended it. Coherent 139, Sienna 188, Credo 534%, Fabrinet 112%. Our custom chips bets, we'll talk more about that with Broadcom up more than 115%, and memory up 154% for SK Hynix, 124 for Micron. Austin, these are buckets that get overlooked by a lot of people, but have led to really strong outperformance. And frankly, I've had a lot of good news in recent weeks. So, while the media continues, again, if you go and you search AI bubble, I should put that in Google Trends. That's probably an all-time high right now. Well, the media focuses relentlessly on that. We have seen some very positive developments, especially for these subcategories we focused on the portfolio. And especially in the past week or two, we've seen some tremendous developments out of earnings, especially for a stock like Credo, which we'll talk about later.
Yeah, I mean, early congratulations there on the Credo earnings. You and I were texting about it. It was fantastic. You had some other stocks in the portfolio popping as well. Marvell came to mind, but we'll get to earnings in a minute here. I really want to learn about your trip. So we're at this point where we've maybe got AI investing enthusiasm down. I mean, it's down 80% from early August. It's not down 80% all-time highs, but 80% from the peak. That's substantial. I mean, it's trading like interest in this is trading like an AI stock. Or quantum stock maybe. Let's add a little extra volatility there. 80% is quite a drop. But you actually went and you saw some shovels in dirt to really put this build out into actual perspective. So you flew to Abilene, you took a big trip. And I want to hear about the scale of what you're seeing. I have not seen the data center build outs in Abilene, but I remember in an earlier episode a couple months ago this summer, we were talking about the data center that Zuckerberg was building out and overlaid over Manhattan. And that visual shows just the absolute scale of that data center. And since then, we have had a dozen, 10 announcements of similar or larger data centers. And we were like marveling at just that single one back then. So tell me what you saw in Abilene. Tell me about the actual build out going on, the concrete being poured, the actual copper being laid, or light fiber optics being laid.
Yeah, Austin, as you were talking to, I did put an AI bubble into
Is it all time high?
If you're watching on YouTube, you need to see this chart. It's absolutely
we're
incredible.
We're going to put it up. We'll put it up. We'll put it up. And that makes perfect sense, right? As you said, but that coiled spring, right, of negativity can only work in the favor of the investor who is patient and willing to buy into the teeth of drops.
Yeah, and so getting back to the question you asked, I'm sorry, you're asking this great question, and I'm busy Googling AI bubbles. But yes, I live, Austin, where you used to live here as well, Northern Virginia. It's commonly known as Data Center Alley. When you drive down, out by Dulles especially, you just see data centers everywhere. There's about 50 million square feet of data centers in the area. For perspective, that's the same square footage of office space for the central business district of Seattle, which if you've been to Seattle, there are hundreds of towers. And that is how much data center space there is out in kind of this semi-rural area outside Washington, D.C. Historically, it's 20 to 25% of all data centers in the country in this one small area. And of the hyperscale data centers, I think it's closer to 35. So Austin, this is a very dominant area. It's inescapable. And for all this dominance, there's about 5 gigawatts of capacity in Northern Virginia. So, where I was going was Abilene. And the construction project going there is the first phase of Stargate. And Austin, a few fun facts, let's call it for this. When I showed up, one of the first people I talked to said the workers on site call it Project Ludicrous. Now, the reason they call it Project Ludicrous is they're building something 10 times bigger than anyone on the project has ever built, and they want to do it 10 times faster than they've ever worked on a project. The actual site, Austin, is 11,000 acres. We drove around it repeatedly. It takes more than 20 minutes just to drive around the site. Every single day, 10,000 workers flood in. And the entrance is a highway, but it's a highway just for construction equipment.
Amazing.
At almost all hours we saw, there was dozens and hundreds per hour of heavy equipment trucks bringing in everything that needs to happen to build this data center. Austin, the final outcome is a 1.2 gigawatt data center in this one spot. That is almost, it is, you look at a map and there's the town of Abilene nearby. It looks like an entire district of the city. So I brought up this data center alley, how Northern Virginia, its identity is that it's the data center capital of the world. And this one project, just one project, is 25% the size. So Austin, I think there's two things to appreciate here. I wanted to go down. I wanted to see this myself because the scope is just absolutely incredible and something you need to be able to see firsthand to really appreciate it. Austin, I think about when I think about what I was witnessing. You think about learning in school about the early 20th century, towns like Pittsburgh and Bethlehem and these massive steel plants going to build this new economy, that we were going to have skyscrapers rising across cities and this 20th century American economy. What I felt as I was standing on the ground in Abilene was the birth of a new kind of factory, a 21st century factory, because we are going to have these data centers rising across the country, and they are producing the new core of the 21st century American economy. And that's really putting a fine point of it. But this is the sort of transition that's happening right now. This is the sort of economic transformation happening in real time when you see this. And second, Austin, it feels like a gold rush. I mean, there's no other way of putting it. Austin, this one data center is going to cost $60 billion. But here's the thing. In the Stargate project itself, Abilene's just the first, but they're building one in Shackleford, Texas, Milam County, Texas, Doña Ana County, New Mexico, Lordstown, Ohio, Port Washington, Wisconsin, and Austin. This is just for Stargate. There's also what XAI is doing, Colossus, which is going to be a similar size in Memphis. As you noted earlier, Meta is building their Hyperion campus in Louisiana, rural Louisiana. That can expand to 5 gigawatts. In one single data center the size of Manhattan, there's going to be the same capacity as Data Center Alley, the capital of data centers that was built over decades in DC, happening in one single build. Microsoft's building Fairwater, which is a multi-gigawatt project between Atlanta and Wisconsin. AWS, Amazon's building a massive campus in Indiana. Anthropic is building a massive campus. Nebius is building one in New York. Awesome. I could go on, and believe me, I've spent a lot of time categorizing all these and trying to get my arms around everything that's happening right now. But the key idea here is, if people think we're on this kind of continuous slope up, it's not. We're on an exponential curve that's asymptoting right now in terms of the size of these data centers. That what's happening in Abilene is the first, but we're about to see dozens. And when you build data centers this large, there's new architectures. And this is what I'm talking about with the gold rush. I watched those trucks go in, dozens of them. I talked to everyone on this project. I would sit at the bar of the one nice hotel in town that literally everyone there was at this project. They're all electrical engineers. They're all a new kinds of picks and shovels that isn't NVIDIA chips. How'd you power data centers this large, Austin? How'd you connect this many chips to work all at once when it's this size? How do you link these data centers together? How do you create the cooling for these data centers? These are all ideas that are incredibly different than what was built 2 years ago. There's new demands. There's new companies that are going to make a fortune from this. And that's really the key. So, Austin, I want to talk about, we talk about AI and the numbers, and it's easy just to be like, oh, another large number, another high growth rate. It's another to be on the ground and see it happening, because it is truly awe-inspiring, and it really hits home what kind of transition today. Like I said, these are not data centers anymore. These are 21st century factories producing a new kind of economic good. So I'll stop there. I know that's a lot, but that's why I went to Abilene.
I mean, when you put it that way, I don't know how anybody could be anything other than excited here. And we've made this point in the past, so I'll tread over it quickly. But that is one of the reason you carved out an interconnects and fiber optics portion of the portfolio so early, because when you see things this size and you realize the thousands of miles of cabling that each individual center uses. It's hard to grok the scale of this, right? You see these buildings, you're like, wow, that's a really big building. And then you actually realize the tonnage of cabling, of chips, of cooling that has to go in it, right? Cabling happens vertically, it happens horizontally. When you actually see one of these racks put together, I mean, an individual rack could have thousands of feet of cabling, and then you start to multiply that by the number of racks in a facility and the number of facilities you're talking about. You almost have to start doing what you did, where you go and drive around these projects and realize it took you 20 minutes to drive around one of them, and then that there are dozens of projects like that, and then within each project there are these thousands of miles of cooling infrastructure, cabling infrastructure, just to start to appreciate the scale of it. So thank you for doing that. And the more we can find, I don't know if you took any photos from your trip, but that might be a cool thing if there's any opportunity to throw some up on the screen here so people can see what you saw. But to hear you describe it that way, I don't know how people could be anything other than just inspired.
Well, and Austin, you think about too, yeah. So getting power to these data centers, you know, a data center that's 30 megawatts, or something that you might see in the Northern Virginia area, that's going to be a pretty standard grid connection. You look at the scale of these and realize this is fundamentally going to change the natural gas market. There are dozens of downstream stock plays from this.
Right.
As you noted, the cabling that happens, we're moving from the largest models a couple of years ago being trained on, thousands of chips working together, to these data centers of this size being 1 million. That's what's driving the optics boom right now. That's what's causing these levels of profits. You think about, kind of the cooling infrastructure maybe being in the order of millions of dollars for one of the old data centers, and changing to billions for these. Once you start putting the numbers together, it really blows your mind. It does. And that's where we've been starting to adjust some of our investments for this, kind of where we see some of these trends coming in. Some of those stocks, like a Tecogen, which is very speculative, it was recent. The thing is, as I was noting, a lot of this current build, as much as people think we're at the end of a bubble, it's just beginning. It really is. You see this, like I said, this is the first of this Stargate project, and they're going to be built across the entire country. Once you see it firsthand and know that we are the first of this kind of gigawatt plus kind of data centers, and there's more than a dozen on the drawing board about to happen, and several that are larger, you realize the kinds of revenue that's going to flow in if you are invested in the right types of companies.
Yeah, one of the podcasts that you and I enjoy just for side entertainment is Real Life Lore, and I feel like this. I'm sorry, podcast, YouTube channel. I feel like somebody needs to get in touch with that channel to do a project here to help visualize the scale and scope of these projects. They've done a lot of really great mega infrastructure projects. So this is our request out there to the YouTube channel, to whoever's on that channel who's listening. I would love an episode trying to visualize for our listeners the scale and size of these data center build-outs, and contextualizing things like how much electricity is consumed, and the visuals that channel's done so well. But hey, let's move on, because there's a Goliath versus Goliath battle teeing up here. And I find this one fascinating. So I'm talking about Google's TPUs versus NVIDIA's Blackwell. And, what's interesting to me about this one is that Google's had their TPU, which is an ASICs chip, for a long time. And this is a purpose-built, so ASICs are application-specific integrated circuits, and they are custom designed for one, more narrow or specific task. So they're not as flexible as GPUs, which is, of course, what NVIDIA is selling to power this AI revolution. But they have the downstream result of being, because they're application specific, they're generally a lot more energy efficient at that task, right? You're removing a lot of the excess, capacity and power demand. So Google's TPU is something that they've had in-house to train YouTube for a long time, and the biggest story right now is that Google is going to be selling this to potentially Meta to build, their TPU chips to Meta. What's interesting to me here, though, and you'll know what I'm talking about when I use this analogy, this is like the investment thesis that's been out there for years that people kind of forgot about and rediscover every couple of years. And the the Macy's real estate thesis, right? Like, oh, the real estate that Macy's owns is more valuable than the market cap of the company, right? It feels like that thesis
Yep.
sort of
Yep.
came around every few years and people rediscovered it. People have been talking about Google's TPU as a business line for a long time. And it's surprising to me that it ended up sort of getting rediscovered now when Google's one of the most covered companies on earth. Let's talk about what people are saying about these chips and
Hmm.
what you're seeing, and then we can talk a little bit about the investment implications.
Yeah, I think that was a good tee up on what TPUs are. As you know, you stated, you go from CPUs to GPUs to TPUs in terms of kind of from being general to more specific. But yeah, this has become the biggest story in investing spheres. You know, you're not going to open up probably CNBC and see a headline about TPUs, but if you're talking with people that are in the investing space, this has been the red hot core of what's being discussed and moving market cap in a way that it might surprise you as we get into how much this NVIDIA versus TPU debate has shaped performance across the entire AI sector. So, Austin, you know, the background is NVIDIA right now, they're charging 70% margins. So if you're a company that, you know, all of a sudden you think about Meta, it's a $200 billion top line business spending $100 billion in capital expenditures. This is now, right, 50% your revenue in terms of costs is just buying compute. So if you've got a company that you're paying that $100 billion to that's commanding 70% margins, you can see, well, you're really incentivized to find a way either around that company or to reduce that structure. And with TPUs, Google's looking at more of a 40 to 50% kind of margin on that cost structure to a company like Broadcom and some of the other partners. So if you can have that and you can get a lot of traction, you have what might be a massive competitive advantage, right? That this all of a sudden it's we're talking about AI compute being a $500 billion plus, maybe up into a $1 trillion annual industry. If your margin profile's 20 percentage points better, you're going to be kind of the lowest cost producer of tokens, right? And you're going to be able to win in this market. Do you have something to say, Austin?
Well, I'm just, one of the things we've talked about is ultimately, if, this is not a new idea, but if you really get the AI industry down to its most fundamental level, it is who can effectively capture and control the most electrons in the most efficient way. And that's sort of the argument that people are now seeing in TPU is that they are so affordable. And that margin conversation you're talking about is one of the driving factors there, right? Like if the custom chips have a 40 to 50% margin, you can buy more effective compute per dollar. Now, I want to be clear about
Mm-hmm.
what you're saying and actually clarify a little bit. And maybe the answer is both here. When you're saying at the 40 or 50% margin, do you mean that is that on the sale of the chips, in which case the buyers can buy more compute more effectively than they can from NVIDIA, even though NVIDIA's chips are better and more broad based? Or do you mean it's a 40 to 50% savings on energy consumption? Because after you bought them, because my understanding of the TPU advantage, aside from being more affordable initially, is that they are also significantly more efficient per kilowatt, even if they're not as powerful of chips. So is that 40 to 50% margin on the initial acquisition or on the long-term utilization, or is it both?
Well, you are asking the $1 trillion question right now, Austin, because
Mm.
I'm specifically referring to margins
Right.
for the companies involved here, an NVIDIA versus a Broadcom or a Marvell or the compute companies. But your question gets to the core of what you're ultimately getting towards is a total cost of ownership. And that's been the big debate in the past couple of weeks because total cost of ownership is going to factor in the cost of the chips, the energy cost, and relative performance. It's a very tough thing to really get at. And a lot of the information is proprietary. But what happened was a company named Analysts had published
Wait,
some
you read semi? Wait,
research.
you read semi-analysis?
I have read it once or twice, but
You-
this is a company. They're
Eric, do,
they're driving the narrative of the
Eric, do you want to
market.
put
It's
your
pretty
affiliate code
impressive.
up there? I think semi-analysis has to send you a thank you basket at this point. I don't know how many members you've sent their way.
I think we've sent them some traffic, but yeah, they sent some that basically the total cost of ownership for TPUs was essentially better than the current generation of NVIDIA. Now, Austin, I will say what's happened from all this debate, if we look at two baskets, basket number one is companies that have broad exposure to Google and this kind of TPU infrastructure. That would be Google itself, Broadcom, which does a lot of design work for TPUs, Lumentum, which has massive inroads in something called optical circuit switches, Celestica, TTM Technologies. That's one we haven't talked about. They do kind of the PCB boards for TPUs themselves. If you look at this as a category, it's up. If you index from a point of 100 last November to today, it would be at 265. And they've been outperforming dramatically. We'll put this on the screen. If you look at the companies that are more exposed to NVIDIA and OpenAI, they would be at 134. So only 34% gain versus 164% gain. And I'm talking about companies like Oracle, AMD, Microsoft, NVIDIA, CoreWeave. So Austin, right now, the market is really pricing in some massive gains for this kind of TPU complex. And the reason why, it's a few things. Number one, Gemini, Google's model, looked very strong. We can
Really
talk about that a little bit
rollout,
more.
really fantastic rollout. Changed a lot of minds. People who were not previously using Gemini. I mean, now we joke about this. Every 6 months, people are like, oh, this new model from this company is like breathlessly good. And then we wait for Claude to come out, and then or Anthropic, and then we wait for OpenAIs to come out. So I don't know where we are in that circle. But no doubt that the recent, version is Google's Gemini seems to be top dog. People are blown away, not just with the broad model, but specifically also video generation. People are using and really happy with.
Yeah, they released Gemini. It's moved to a lot of the leaderboards, as you noted. It's very good at a lot of categories like spatial awareness, and this is really fueling a narrative for all things Google connected. But we also have Meta, as I believe you noted earlier, looking at going big into TPUs, and Anthropic. I believe there's an order of 1 million TPUs just from them. But Austin, the key point here is when estimates for TPUs come up, companies in this TPU envelope, they can really see some incredible gains. So an incremental 1 million TPUs next year, from estimates I've read, could add $10 billion of revenue to Broadcom. Their estimates for next year are $86 billion. So that's a massive increase in terms of total revenue. TTM, the company that builds those printed circuit boards, backplanes that wire together, chips, memory, and interconnects, and TPU, they would see an incremental, from the estimates I've seen, $800 million from an extra 1 million TPUs. Austin, the company's total revenue next year is $2.9 billion. So an extra $800 million. And Celestica, a company I've talked about many times, I talked about buying them at the bottom when we weren't adding to the portfolio, but I was giving my personal buys. They would add $500 million from an incremental 1 million TPUs. And that's against total revenue of $16.2 billion. But Austin, the estimates are now maybe 3 million TPUs in 2026, 5 million in 2027, and 7 million in 2028. So anyone out here can do a little bit of math and see why every company in this TPU cycle has seen such phenomenal gains, because it really is a fairly tight group of companies. And as these estimates go up, some of these companies begin looking at doubling versus expectations of what Wall Street expected. So I'll just end it with a few key points, because I know that this is a very broad discussion. Number one, I think NVIDIA is going to be just fine. We tend to get very zero sum in our analysis of companies. NVIDIA is going to have strong leadership through their next cycle, which is Vera Rubin. And TPUs are having a moment right now. Like you said, this narrative, it flips and it moves. On that point, my second point would be, the narrative is at peak Google right now. OpenAI is readying their next model, which is 5.2. There's been some reports it's very good. If that is very good, Austin, what's going to happen? The narrative's going to flip back towards a lot of these OpenAI kind of aligned companies being back in the sun for a day. And third, it's not pure gravy for Google, because if they do want to go out and sell TPUs, they are reducing a key competitive advantage for their own cloud hosting. Also, being able to get enough supply for these, there's years of lead time in terms of getting
Right.
supply from Taiwan Semiconductor. So there's an opportunity cost. If you want to, you can only produce so many TPUs. So if they're going out and selling them, they might not be able to use them to serve their own models where they're trying to gain market share. So
Mhm.
there is a little bit of a tough decision for Google to make here. So overall, though, Austin, I just wanted everyone out there to understand the company is aligned with this TPU complex, why they're seeing such strong gains. We own some of them in the portfolio. And to say, I think the market, it was pricing in a panic for Google, Nvidia. That's kind of reverse, but I don't I don't have a zero sum mindset on this, and I think Nvidia is going to be just fine.
Good context there. I'd love to just put you on the spot a little bit here. Google is not in the portfolio, and I'm curious. You've chosen sort of smaller, fewer play exposures based on different subsectors like cooling or interconnects or chip manufacturing or chip design. Is the reason for keeping Google out of the portfolio that it's too diversified? It's not as good of an AI pure play, or is it now that this is actually Google's becoming more of an AI company and you would consider it in the portfolio? I'm not asking you to make a call today. I'm just curious how
No, no.
news like this changes how you're evaluating Google as an investment in the AI landscape. Because Google's obviously a lot more than just AI as well.
Yeah, yeah. When we first started the podcast, I remember we had some early episodes where I said Google is one of my least favorite ideas, and we gradually turned more bullish. I said earlier in this year, I said I've done a almost 180 on Google. I think I said I've done 179, and as I had noted earlier, for a little while we weren't buying stocks in the portfolio for reasons beyond our control. We had some disclosure things happening with some consulting work we were doing, and I was giving personal buys I had done. If you go back to those episodes in April, and I had said I was purchasing Google personally. We record videos for our YouTube channel of if you're starting with AI, what stocks should you buy? And I said Google would be my top one. So I think, Austin, is just sometimes Google's more a victim of circumstance where when we took our existing cash and we dropped it in Meta and Amazon to kind of have investments in lieu of leaving that in cash at the time, I wasn't as bullish on Google, but I've also been kind of loath to sell off Meta at extreme valuation discounts where it's been trading recently.
Right.
So I think if we had started fresh and reallocated mid this year, I would have preferred Google among the mega caps. But that's the difficult thing with investing, right? It's always what you're currently invested in. Are those stocks artificially in your beliefs lower than they should be, tax consequences, et cetera. So I think we've been extremely bullish on Google, and it's run up a lot. So I think amongst the Magnificent Seven performers is the top performer this year. So people who own it have done very well.
From last to first, I mean, it's hard to appreciate how much of a outsider Google was on the Mag 7 companies until very recently. I mean, Google was hanging out at the bottom of year-to-date returns at Enthusiasm, and only 6 to 7 months ago, and people were saying Sundar had missed the boat, and boy, the empire has struck back with vigor. Let's get into some of the earnings. I know people want to hear about how some of the companies in the portfolio specifically have done. We've done a lot of macro talk. We've talked a little bit about this Google TPU versus NVIDIA dynamic. I would like to hear about some of the earnings in the portfolio. You've got some winners and some losers. I think most of the winners that we've seen in the last few weeks were interconnect focused. Software has been a little more challenging as a space. So let's talk a little bit about GitLab and Snowflake. GitLab's down 8% over the past week. And could you just start a little bit for anybody who's tuning in now, just a quick one sentence, the thesis around GitLab, what role it plays in the portfolio so that people can orient it, and then what you saw out of earnings.
Yeah, GitLab does DevSecOps, which is basically code management. If you want to boil it down, it's being able to do security, deploy your code, manage it across the entire life cycle. So we originally bought this. I'll get into it a little more in a second on the thesis that the rise of agents would eventually be bullish for this company. Now, as you know, it's down 8% across the past week. is now down 11% since we had re-recommended it. Our first recommendation is down even more. Austin, the story of 2025 for this company, it's lots of companies have been circling to acquire it. Its primary competitor, GitHub, had previously been purchased by Microsoft. It's a very logical acquisition in part because it's a cheap play. It's got good growth and it's cheap, which is one of the reasons we added it to the portfolio. Now, the reason for them declining after their most recent earnings was conservative guidance, which has been a recurring story, which has allowed the market to continue kind of pricing this stock down. And Austin, this is where we're at. Sometimes you have a point. You've made a call on a stock. The market views it differently. That's where we're at with GitLab. I thought they were eventually going to be a beneficiary of kind of the rise of agents. The market is pricing them for agents to kill their business. So far, we have been wrong. Now, the question is, will you inevitably be right? Did you make a wrong call that you need to cut bait? Or is the market just not seeing through to the future? I still have confidence in this company. I don't know if they'll be acquired in the meantime, but Austin, my belief is that the rise of agents will actually really increase their business. If you look at the pricing of their specific products, they can charge about 3 times as much for companies that are going to be deploying agents and the kinds of the kind of licensing they're going to need to buy. So the market is pricing in that agents are going to lead to fewer software developers, which leads to them selling fewer seats. My belief is the opposite of it. So at this time, even though GitLab's down, it is one I still believe in, and we'll watch this story throughout 2026. But it's been one where right now we are on the wrong side of the market, and sometimes that happens. And like I said, I still have confidence in the stock.
Well, we've said this many times. We will say this many times more. This is why you build a portfolio, right? Even theses that make sense, even ideas that seem perfect on paper. When we run up against the reality of things, the future is inherently unpredictable. And in a portfolio like this, if you're batting 60%, you are doing fantastic, and that's because the 60% that you bat correctly goes up a multiple of the 40% that either match the market or lose to the market. It only takes 1 or 2 good credos in there to make an entire portfolio, and you have more than just a few, but this is why you have a portfolio. So just a reminder to people out there, when you're making these picks, please size positions accordingly. A thesis can make
we're in a greedy market right now. You think about, Austin, people underestimate the impacts of compounding over time. Warren Buffett across his entire career averaged 20% a year. If you go on Twitter now, I see people making fun of each other for returning 20% a year. That is phenomenal. You would pray for 20% a year annualized. Like, no one can achieve that over a very long time period. And this is just kind of part of the world we're living in, part of a lot of the gains across a lot of sectors that people have kind of piled into. But it's not a long-term reality. And as you noted, last week we said it's a problem to be batting 100% because you're probably not taking enough risks. The market is, you are praying for 15% annualized and 60% win rates. And I know that's hard to remember in go-go markets, but that is the game we are playing.
And it adds up to something truly spectacular. It's like a compute chart. Let's move further along here. I want to talk about another software play that has had some weakness. This is Snowflake. A little bit of a pattern here. Software is not so much in vogue. I think we've also seen this with other plays in the portfolio. Synopsys has been a weak performer. We've got 2 picks there, both of which are down slightly. Not much. I'm seeing down 4 and down 9%. But we've got some weakness out of GitLab and Snowflake as well. So software is on the outer ring right now. Let's use Snowflake. What are we seeing in Snowflake's earnings that indicate what's specific to Snowflake and what is broader just disenchantment with software today?
Yeah, as you noted, the problem with software is, well, there's agents, and a lot of the rise of AI is seen more of a threat to its model than something that's been beneficial. And Austin, you don't always know when these narratives are going to change, and that's why you want a portfolio built along multiple themes. And software has been one of our laggards so far, but one stock that's kind of bucked the trend on that is Snowflake. It was down after earnings, but it is up 45% year to date. Overall, Austin, I saw a company with a very good quarter. With software, there's always what you can book in a quarter for future business versus what you can record in revenue. Their RPO, which is what they're booking for the future, grew 37% versus 27%, recorded revenue. And also, they topped $100 million in AI revenue, which two things, it's growing very quickly, but at 100 million, it also shows it's still less than 10% of the business. So in any given quarter, whether or not they exceed expectations is less about AI versus other factors at the current time. Austin, the bottom line, this is one of the few software stocks that's very expensive. They have to perform brilliantly at high valuations, and they had a somewhat average kind of quarter, and that led to some air coming out. I would say, if you are someone who's been following the portfolio, if you haven't bought Snowflake, if it's trending down to $200 or in that range per share, I think it's 225 as we're filming, maybe use that as an excuse that you could add the name. I would also say some other leading stocks in the software space to look at, something like a ServiceNow. This is a company with a really solid placement in AI. It's down 16% year to date, and that's made its valuation very reasonable. So, it's always, if you've got a lot of high flyers in your portfolio, there's ways to balance it with companies that do have great tailwinds, but the market's discounting at this moment. I do think, well, again, it pays sometimes to shop where no one else is interested at this moment, because narratives do change. And I think some of the values in software are looking pretty compelling right now.
Really good guidance there, and thank you for bringing in ServiceNow. I was trying to look up some stats, and maybe we'll be able to flash them on the screen, just about how much ServiceNow is down relative to their dollar cost retention, how good that company has been, how interesting that company is getting on a uh, multiple basis compared to what the core business is doing. But let's move on to the company we've alluded to a couple times, which is Credo. Absolutely stunning earnings, one of the balloons in the portfolio, and that it's really buoying the returns here. And this is that transition, as we're building these 1,000-acre data centers, and we're looking at interconnects thousands of miles long, and as we move from copper to light, to like this company is square in the middle of it. So talk to me about what you're seeing in earnings, and the they absolutely smashed it. They absolutely
Yeah.
smashed it.
You were talking about the cabling earlier. It's become almost a meme in investing circles of seeing the color of Credo's
Right,
cables
which
when
is
you see a data
purple.
center.
Right. Yeah.
Yeah, yeah,
And
yeah.
Credo has this
So
very distinctive purple. And actually, you know what? Maybe we could find an image to put on the screen over here, because actually that is one of the very small ways for people to visualize just how much cabling is required per rack. And then you multiply that times racks and then times facilities to really understand how many times we're wrapping around the earth here with Credo cables.
yeah, and what Credo does is they've had a very unique advantage that, as we've talked about, there's limitations to copper cables. They have advantages in terms of power consumption, but especially with physical link, they have limitations. They build cables, active electrical cabling, that is far more efficient and has been just gobbled up by companies. So Wall Street was expecting 248 million in revenue in next quarter. They guided to 340 million at the midpoint. They'll almost certainly beat that. I mean, that is like something you never see investing. I mean, that is 1 in 1,000 kind of outperformance. It is truly remarkable. And Austin, the story is too, this is a company that could have been kind of confined to just one niche, this AEC market. But what they did on their conference call is they really outlined a future where they are expanding to be a broad interconnect company. So they're moving into optics, they're moving into micro LED cables, they're moving into something called OmniConnect. That's going to be a central pillar of building out these large, distributed networks of up to 1 million chips working together. This is all very technical stuff, but what we have is a company emerging from one niche to being a broad leader in this interconnect space, and that's really exciting. Credo, it's expensive right now. I think it's 30 billion market cap, and we're talking about a run rate of 1.5 billion on the top line. But this is kind of the game plan of how'd you have 100 bagger stocks. I'm not going to say they're 100 bagger. That's pretty spicy, but It is that you get in early when someone has a foothold and they execute extremely well to becoming an idea you could have never conceived when you first bought it, right? Amazon selling
I was
books.
just going to say, Amazon,
Eventually,
Amazon doing books now sells, Band-Aids, and it is AWS and is an advertising platform. They are the use case for this. And it is the it is the narrative that buoys Tesla shares as well, right? Tesla's not just making
mhm.
cars; they're making Optimus. Tesla's not just making cars; they're a solar company, they're a battery company. It's that upside for the business line that doesn't exist today. That's really hard to price in. But one of the things that can give you confidence is if the company is on the edge of a really good technology and not slowing down on it, they've already showed that they can execute on a new business line, right? So, in a weird way, being a leader of one thing today gives you a lot more confidence that they're going to come up. It can, right? If it's the right leadership team and the right company size, they can build out the next thing and the next product and the next vertical as well, right? They've already demonstrated it once and they're pushing to the edge. And Credo, as you said, is now rolling out different products, right? They're not just sticking with these, they're not just trying to print as many purple cables as they can today. They're adding new things and becoming a broader company.
Yep. No, I mean, like you said, winners keep winning, and this is a management team that has exceptional execution. Which maybe we should go from exceptional execution to very middling execution as well.
Yeah, this is one of the perpetual dogs. Marvell, and Marvell's always been mentioned in the same breath as Intel, but maybe now, these American chip laggards are finally catching a break. Intel in particular has had quite a run the last 6 months. I think it's up about 70% or so. Marvell's been lagging behind, but their earnings were pretty exciting. And you and I were texting about this. They initially fell after earnings, and then I think at some point weren't they up 12%, 14%? They gave some of that back at the open, and then they closed the day down. I mean, sorry, down from that peak, but still up. Um, so the story with Marvell has been, and you've talked about this, the management team has not been good on earnings. They're not good storytellers right now, and you need to help investors understand the role that you're playing in the landscape. And of course, when you're running a company like this, you need to be an incredibly good operator, but you also need to be able to tell your story to investors in Wall Street so they understand how you're positioned. And historically, Marvell has not done a good job explaining their role in the marketplace. So we see some execution challenges. I'm talking historically against bigger rivals like Broadcom and other competitors. So you've got execution challenges married with narrative challenges. You've got a laggard stock in a space that is exploding and should have a lot of potential.
Yep. Yep.
Now it seems like they're finally getting their act together a little bit. So tell me what Wall Street and investors saw that sent those earnings up quickly after hours.
Yeah. So Marvell is a stock I had said in prior podcasts I would give them through this quarter to see how they execute before make a decision if that's one that we would sell. Like you said, if you want to make money the past year, the number one strategy would be the moment their earnings call starts, short the stock, because every earnings they're fading at. It's a lack of specificity from management. It's them muddling what kind of opportunity they're going to have. And Wall Street just hasn't really been behind it. So this earnings call, they were down 6% before. They were up as much as I think you said 14%. And the reason is they gave concrete guidance for next year that was significantly above Wall Street's expectations. Now, Austin, we wanted to own Marvell for a couple of reasons. One, they're in this custom accelerator game we talked about earlier with TPUs. They're a lot smaller. They are 1/20th or now less than that of Broadcom, but they had big customers. We wanted some exposure to that if their major projects worked out. Second, they're huge into interconnects as well, and they're a leader and they made some great acquisitions in the past. So again, it's kind of like there's a rising tide and they've got an anchor to the bottom of the ocean, and we're seeing if this anchor is going to rust out and let it come to the surface. We are seeing some of that happen right now. They, like I said, their growth for next year solidly exceed Wall Street targets. Even if there's some reports that they might be losing business from major customers like Microsoft, they still have enough opportunity in areas like interconnects that they don't need the custom chips that they're building for these big customers to work out for the stock to necessarily succeed. And they announced an acquisition, Celestial AI. It's deeply technical. but the people I respect most in this space think it's a brilliant acquisition. So all in all, Austin, enough from this quarter for us to keep Marvell in the portfolio. And now it's moved to slightly positive, which if you look a few months ago, you can see how fast this narrative changes because it's trading for about $100 a share, and I think it got down to about 50 recently. So, if you're looking at some of our recent recommendations that are dropping, just remember in the short term, narrative swings really quickly. Over a longer time frame, price is going to actually follow revenue growth and business growth.
Right, right. Yeah, it's hard to overstate how negative the sentiment around Marvell was, which is to say that like in this most recent earnings call, the bar was low, right? They didn't have to do much to change to do better. So I think that's what we're seeing here. Still a long execution road ahead, but when you have these really depressed expectations, I mean, even a reasonably good earnings call can get you a good pop like this. So
Yep.
let's bring it home with some quick hits. I want to talk about some comments from our listeners. Thank you very much for tuning in, and I want to talk about Meta cutting its laggard. And you said Marvell, it seems like it's got this anchor at the bottom of the ocean, and people are hoping it rusts out. Meta's had its own anchor. Now that's weird to say for a company whose shares have been as performed as well as they have. And Meta is a much bigger company than the metaverse. But when you think about the one big criticism that people have had of Meta in the last few years that I can think of has been, why is Mark Zuckerberg flushing so much money down the metaverse drain, right? Nobody believes in it. The traction has been really low. So Meta has a lot more going for it than that, and that's been enough to overwhelm that one core criticism. But that has been the biggest criticism I've heard, and frankly, it's a criticism I share. I really like that Zuckerberg is willing to make these big bets. That's what you get with a founder CEO who is visionary in the way that he is. But you also got to know when to fold them, right? And the metaverse is just not been working out. So Meta finally announcing that they're cutting some of the revenue out of that division. Wall Street rewarding it. I think they should. That's the right call. Anything you saw in this that's interesting? I mean, just cutting out from that tiny anchor and saying, hey, metaverse. I mean, obviously, this capital has a higher return for the company and a shorter path to revenue in AI, right? AI internally, AI externally. It clearly a better place to deploy that money right now. Anything else you're seeing? I mean,
Yeah.
is the story more complicated than that? Is there an underlying interesting take here other than Meta finally did what they should have done?
Well, yeah, I mean, if we're doing Glengarry, Glen Ross, what is it? The winner gets a car,
Yeah.
the second place gets a steak knives, and last gets fired. If you looked at the Magnificent Seven this year, Google's kind of the car. Nvidia gets the steak knives. I think Google's up 70%, Nvidia's up like 35. And then the laggards are some combination of Microsoft, Apple, Meta, and Amazon, up 0 to 15%, that range, all kind of slightly underperforming the S&P. So Meta, it has been disappointing, especially from where we purchased it again in lieu of cash. I have wanted to move out of the portfolio. The problem is also, if you go back and look at Meta's stock the past 2 years, it's a very tight range they're trading in between 20 and 30 times forward earnings. And right now they are at the bottom of that valuation. It's because the market doesn't believe in them. Specifically, they were sold off very harshly because of how high their operating costs are rising last quarter. Now, so we've got two sides to Meta. One, that AI has more potential to actually drive their business than any other company, I believe, in the market. There's a study that generative AI leads to 19% better click-through rates on ads. That's going to make their products better. They're going to be able to create new products. We know the ROI, we've talked about it, but if they're spending so much in this rush for ASI and they are behind in those efforts, investors aren't going to believe in that narrative. So I've wanted to see them rise to higher, closer to that 30 times forward earnings, a multiple Google's closer to right now, before I sell it off and use that cash to redeploy. I think this is a great step in that direction. They need to be cutting some costs. They need to show the market they have discipline. And we saw the day that they announced this, they were up 4%. So if you're someone who owns Google, I believe this, or sorry, not Google, Meta, this is objectively positive. If we can see this discipline from them, if we can see AI continuing to actually boost their business results, I think there is an opportunity for shares to trade closer to $900 per share this year. That would be a very bullish case. But if you did that, that would be a great reward for owning this company. And on the flip side, if they continue spending in a way that Wall Street doesn't like, you could see them trading as low as $500 a share. That's kind of the low end of their baseline. So we're going to see where they trade in here, and it's a lot of how they handle this cost discipline throughout the year.
Yeah, it's interesting to talk about cost discipline in a world where Meta is also being punished for spending so much on AI. So, but this is actually what cost discipline is, right? If they believe in AI and the ROI on metaverse isn't there, they need to cut in one category and move that money to the other. And they're doing that. I mean, just yesterday, Meta announced they're going to be acquiring an AI wearable company, Limitless. It's not a big acquisition for them in terms of total tonnage of dollars they're putting out there, but it shows that they're reducing the thing that's not working and putting more money in the thing that is working, which is AI. So that is good financial discipline. Whether or not the AI bets pay off is sort of the next meta question, get it on, that Wall Street has, but they are at least, they're not, it doesn't seem that Zuckerberg is just sticking with the metaverse bet. Poorly timed renaming of Facebook to Meta, but we'll just forget about that. We'll just forget about that. Eric, I wanted to bring it home. We always like listening, hearing from our listeners, and we wanted to read some comments out. And look, just a reminder: if you stuck with us this long, if you're here at the end of the episode, please take a minute and go check us out on YouTube or Spotify. Give us a comment. Let us know what you thought of this episode. Let us know what you want to see more of. We love hearing from you all. Some of the comments that we wanted to talk about were from Nolan. Eric, you want to take it away?
Yeah, Nolan's been a long time listener. He leaves a lot of comments, very thoughtful. We appreciate. He said, "Thanks for the time, guys." This was from our last episode. That macro perspective is so helpful. In the spirit of community building and sharing, here's me attempting to give back. His latest buys are TTMI, which we talked about today, and also Souls, which I don't know what that ticker is offhand. So
That's Solstice Advanced
Hmm.
Materials, and I'm guessing this is I don't want to speak on behalf of Nolan here, but I'm guessing this is a mining play. No, that can't be right.
Yeah, I'm unfamiliar with that one. So, and he said the top of his research list right now is Powell, ticker POWL. That is one of the best performing stocks. It's one that I looked at, and another one of our partners had bought at the beginning of 2024. One I had missed, and the reason is because you have to cover such divergent ideas in AI. It's hard to truly grasp who's going to be a winner across, power generation to the most advanced chips. But Powell's a deeply interesting company, and he said, "My research exercise is using LLMs to create Venn diagrams of the stocks with the most exposure across the sectors you find compelling, i.e. AI plus data centers, robotics, quantum computing, with unequal weights, say 70-25-5. When I have more ideas than conviction, this has helped me rank the potential buys." So I just thought that this was a great comment. Number one, some stock ideas. We'll have to look at Solstice Advanced. And my first exercise in that will be going to ChatGPT, asking kind of the high level questions. And then, Nolan's giving some also ideas along Powell, a company that, again, has more of a play into kind of this energy trade and something we've been talking about getting more ideas in. So I just wanted to feature that because those might be interesting stock ideas out there for listeners. And Austin, as we've talked about idea that before, there's no extra credit for being original in investing. You buy stocks, and if they make money, you'll win, right? It's not, you don't get any extra awards for being brilliant or that. And that's why having a community matters, because if you've got a community of people that are helping uncover ideas and are bringing things, it only benefits everyone. So, we love featuring the ideas. We talked about some rare earth plays from listeners in other areas, and we would love to have more. So anyone out there leaving a comment on Spotify, YouTube, emailing us, we would love to hear it, because again, our goal is to be a community, because when everyone's working together, we all win together. And that's what's important, is making money through what we believe is the single most transformative technology of all time.
Beautifully said. Let's leave it on that note. Eric, I will see you next time. And I know we're a little premature to tease this, but I know you've been looking at making some buys in the portfolio. We had discussed doing it today, and you had paused that. Is it safe to say the next couple episodes, we might have some money movements going on, some announcements for our listeners. That is, in fact, why everybody is here.
Yeah, we've got a lot of stuff that we're researching. Partially, we do consulting work, and we need to make sure that we get some of our research out to our customers. But I definitely have some things that I'm very interested in. We recommend Vertiv on the last show. That's done pretty good sense. I believe it's up 11% since that episode aired. So I think we'll have some more niche ideas in coming episodes.
Wonderful. Well, I look forward to hearing them. I know our listeners do as well. Until then, next time.
The AI Investor Podcast is for educational purposes only and should not be considered investment advice.